Please welcome the panel on Eco Edge, Investing in a Clean Economy, moderated by Leslie Kaufman, Senior Reporter at Bloomberg.
Hello, everyone. I'm Leslie Kaufman. Thanks so much for coming. I think we're the first panel of the day to conflict with lunch, so we're especially grateful that you've made it here. Today, we're going to be talking about investing in a clean economy, but that's a very big term, clean economy. And so as we start ourselves off, I'm going to ask the panelists to introduce themselves. I'm going to say hello as we go and direct it. But I'm going to ask that they introduce themselves and talk a little bit about the part of the clean economy that they're focused on and why. And maybe if you have a project or something specifically you want to point to, that would be fine. So should we, Scott, start down there with you, Scott?
Sure, thank you. It's nice to see you all. So Generate Capital, which is a company I founded 11 years ago, is focused on the really broad opportunity set in real assets and infrastructure. So really we like to think that we're helping rebuild the world, quite literally. It's a $9 trillion a year opportunity, according to McKinsey, to rebuild the world in a way that gets us to net zero by 2050. Of that 9 trillion, 8 trillion is in real assets and infrastructure. And so we try to play across the value chains and across the capital structure with both money and help to actually build these projects. So we partner with project developers, we partner with end user customers, we partner with communities, and we partner with investors in order to bring the right kind of capital and the right kind of help to each of these situations. I think very few people understand the breadth that you're talking about of the opportunity set and the depth of expertise you need within each of these opportunities.
Well, can you just give us a sense of that breadth? I mean, are you talking mostly clean energy, or are you talking, give me just like the farthest ranging projects you're working on.
Sure, thank you. So we started 11 years ago investing in battery storage before anyone thought it was a smart thing to do. And really, obviously, that market has grown dramatically as a result of proof points that it makes economic sense for customers to build projects with battery storage. We also do things like food waste upcycling. So we have built one of the largest food waste processing businesses in North America. We take food waste from folks like Nestle and Chobani and turn it into clean energy. We also work in fuel cells, which is a newer technology. It's really 30, 40 years old in terms of commercial applications, but hasn't been very well established in some of the use cases that you now see it used for, like powering the massive demand for clean, firm power that the data centers need with the AI boom underway. We also work in industrial decarbonization and just financed the first green steel manufacturing facility west of the Mississippi.
Wow.
So it's quite a range of different things, and you have to know how to build stuff. It's not just a spreadsheet exercise like too many people approach it as.
Okay, well, Neely, that brings us to you. I mean, the name of your firm would indicate that mostly you're interested in carbon, but talk to us a little bit about clean energy and what you mean by clean economy and what you're focused on right now and why.
Sometimes I say it's in the name. Right? Hi, everyone. It's great to be here. My name is Neely Gilbert. I'm the vice chairwoman of Carbon Direct. Carbon Direct is actually a holding company with two sides. You have Carbon Direct, Inc., which is a client-facing advisory business. We work with corporations and governments on their decarbonization journeys. The coolest thing, if you only remember one thing about Carbon Direct, Inc., it's our science team. We've got a science team of 80 people, about 60 PhDs on staff. Today, I'm going to speak mostly about Carbon Direct Capital, which is our investment business. The science team also supports our investment business in diligence of the deep tech investment that we do. Carbon Direct Capital, we're really focused on investing in carbon management technologies. So we're doing growth equity investing, not early stage investing, and primarily technologies for industrial decarbonization, which Scott mentioned. So in terms of examples, you can think about things like point source carbon capture to capture emissions, in high emitting assets at the point of production. Imagine a cement plant or a power plant. We'll invest in technologies that produce clean fuels for sectors that are too energy intensive to electrify, hard to abate sectors. CO2 utilization, I like to call it carbon recycling, or the circular economy of carbon. You can take captured carbon and produce useful products that displace fossil fuels as an input. And then lastly, carbon removal. There's a huge stock of CO2 out there in the atmosphere that we need to remove and store or put to use. You can do this with engineered solutions, and we also separately have a fund that invests in nature-based solutions to capture carbon. You asked why we're excited about this field. I really feel that carbon management and industrial decarbonization, they are both a huge opportunity and also still hugely underinvested. When you think about heavy industry and hard to abate sectors, it's about 40% of fossil fuel use worldwide. About a third of global emissions are coming from heavy industry and heavy transport, yet only about 1/100th of the capital has been allocated to carbon management that we've seen go into renewable energy over the years so far. But as an investor, this is actually really exciting. These are huge addressable markets. There's a huge audience of off-takers across heavy industrial sectors that need these solutions. And so that's why I'm really passionate to be investing in this part of the space.
Terrific. Mark, this means we turn to you. You deal with a slightly different pool of investors, and I think we talked a little bit about de-risking in that role. But I'll let you put it in your own words. Again, the question being, when you think about a clean economy, where are you focused on and why?
Great, and I'll hit that at the end. So I'm a partner at Capricorn Investment Group. We have 3 business lines. First and foremost is our outsourced chief investment officer business. We were founded 25 years ago, initially as the single family office for Jeff Skoll, the co-founder of eBay, which had a very clear climate focus in terms of constructing a portfolio. Over time, we started to bring on additional families and ultra-high net worth individuals and foundations. Obviously, those are confidential. One other that we can disclose is obviously Al Gore, who is very, very focused on climate through his asset management company Generation. But our job essentially is to construct, manage, and oversee portfolios from public equities, fixed income, to real assets, private debt, private equity, and venture capital. And many of our clients have a different focus. Some of it may be really narrow on water. How can we have a water-focused portfolio? Or it can be more broad, more of a very focused climate portfolio. And so we typically invest in asset managers like Neely and Scott. And the market today is much different than it was when Jeff Skoll started this 25 years ago. We don't have the plethora of experts like these two here. And so Capricorn actually helped jumpstart some asset managers early on as well, one of which was a leading sustainable asset manager called Vision Ridge in 2013-14. The first fund was in 2015, which takes a private equity approach to sustainable real assets and has essentially owned, operated, and sold some of the most unique companies in electric transportation and electric mobility infrastructure. And then thirdly, the firm is also a venture capitalist. For 20 years, we've managed a few portfolios totaling $800 million across about 35 really deep technologies, things from battery recycling to some of the things that Neely looks at, to grid management, to alternative forms of steel, all of it. And so that's kind of what we do, and I think our focus now is on bringing on new institutions and families so that we can do what we've done for the ones to date.
Okay. Arij.
Great. Thank you so much. And it's great to be here. My name is Arij Al-Shakar. I'm the CEO of the venture arm of our national energy company, Babco Energies, called BE Ventures. The way that we look at the whole clean economy is that we have a 90-year-old oil field We discovered oil in the GCC region, one of the first to discover. And over the past, over 90 years that we've been blessed with these kind of resources. Of course, as everyone knows, these resources will eventually decline. And our countries in the GCC have also committed to a carbon net zero by 2060 and 50% by 2035. And our role within the venture group is to look at various technologies that we can bring in to support our current assets, whether it's our refinery business, our upstream business, but we also have a very focused national energy strategy where we're looking at the future of energy and energy transition. And that's diversifying our power mix, which is very much introducing clean resources of power to be able to bring it into the power mix. And how we manage our carbon emissions. We have heavy industry. We have the second largest aluminum smelter outside of China in Bahrain. And so there's a lot of opportunities for us. And the way we've positioned Bahrain is that we're a small island, but we're very much just a causeway away from Saudi Arabia and very close to the UAE and very strong relationships across the region, but we're also small and nimble. And so we've seen that introducing and having a lot of the technologies that are based out of the US and in Europe come over to the GCC and basically pilot into kind of like an incubator or some kind of springboard out of Bahrain while working very closely with our neighbors. So we're very excited about this space, and we believe that it's definitely part of the future for the GCC as we all have our carbon net zero goals.
Terrific. I want to thank, that's an impressive panel, right? Right there. So I'm thrilled. But I thought, Neely, we'd go to you with the next question, which is, I feel like, maybe I'm just old. I've been doing this for a very long time. I feel like people have been talking about a clean economy for a long time. And sometimes it feels like we wax and wane. And, certainly coal use has gone down, but total carbon output. So there are a lot of different measures you would look at. I'm trying to think, when you think about a clean economy, what are some of the metrics you're trying to use to measure our success? And how do you think, what moment do you think we're at right now?
So it's in the name, I think a lot about carbon and tons of CO2. But maybe I'm old too, Leslie. I've been in this field for a long time. When I was in business school, I graduated from Columbia Business School in 2003. And at that time, even then, I was interested in how do we bring thinking about environmental and social issues into traditional finance. I had to design an independent study to be able to focus on that.
Can I jump in?
Yeah.
So I was not smart enough to go to the Columbia Business School, but I would have graduated 20 years ago as well. I teach impact investing at the Columbia Business School. They now have a complete focused climate program. I'm sure you're aware of this.
Yes.
I teach the flagship impact investing course, and there is a wait list not for this moron, but for the class.
That's amazing.
And then they go on and take other climate-focused, either infrastructure or venture capital classes. So what you started is now a whole institute and curriculum at Columbia. So sorry about that. That was not planned.
They're individual people.
Touches my heart.
Go on.
So so this was back in 2003. In 2005, I became chair of my first Rockefeller Family Investment Committee. Today, I chair two and advise a third. But ever since 2005, and before that, the family has cared a lot about what back then we called mission-driven investing, right? And mission-driven investing actually goes all the way back to the Calvinists, right? And like Max Weber and the Protestant work ethic in the 1800s. You asked about how I think about progress other than tons of CO2. And so this has been a long journey. And I think for those of us who are in the space now, who have been in it for this amount of time, we have come to a place that some of us maybe never would have imagined. We hoped, but didn't truly imagine we would get to. But what I've seen over this period of time is it's a long arc of progress, but not a smooth arc. There are ups and downs. You have market cycles, you have sentiment cycles, you have political cycles, and I think that we're in one now.
Get to that, boy.
Today, look back over the past 5 years and the very strong sentiment and action that we had around voluntary climate action. Today, the zeitgeist is that as we focus on climate and climate finance, that it needs very much and to be rooted in serious business, economic groundedness. Just focusing on the climate imperative is not enough. But I actually think that that is okay. I think it's a good thing for this next stage of progress, because what good looks like, the brass ring that we're all reaching for, the $9 trillion that Scott talked about, we have to be able to drive progress in a way that crowds in massive amounts of private capital, and that has to be done on the basis of just serious, good business and dollars and cents. So where I think we are today is a kind of a maturation, also that the ecosystem is ready for because of the progress that's been made to get here.
I couldn't agree more.
Go ahead, because you're always the optimist in the group. So
Well, I hope I can bring that optimism here. I would say that, Generate started in 2014 with a very clear vision to prove that sustainability pays, recognizing exactly, as Neely suggested, that the only way we're going to mobilize $9 trillion a year is through the profit incentive. There is a very important and valuable role for philanthropy. There is a very important role for government. But if you want to mobilize $9 trillion a year, you've got to do it with markets and market incentives and market models. If you look at all of the philanthropy across all of human history, you won't find $1 trillion. So to get to $9 trillion a year, you obviously have to mobilize markets and business. And so we really see this as a terrific moment in time where we actually changed our vision at the 10-year mark for Generate. We believed we had proven sustainability pays. In our first 10 years, we delivered private equity returns across many, many billions of dollars with infrastructure risk, all focused entirely on sustainability and climate solutions. Our investors were asking us to take more risk, to do more work, to go to more places. And so it was a clear indicator that we had actually proven sustainability pays. So we planted that flag and we said, what's next? Well, what's next is accelerating the transition to a clean economy. And that's where we go from the $2 trillion last year that was mobilized for this transition to the $9 trillion that we need. It's about accelerating this, mainly focusing on what we know from the last 20 years. And we have to learn the lessons, both the failures that have occurred and be honest about them, but also really give much more amplification to the voices that can share the success stories. There are so many success stories if you look just asset by asset, customer by customer, community by community. You have to pierce through those headlines and you can actually see what is happening on the ground in the real economy for real people. And those solutions are delivering the most compelling economic opportunities for people. And that is why people continue to choose to do the transition type work or implement the transition type infrastructure that we would invest in.
Mark, so is that right? Should we be measuring this progress in investment and returns, or should we be looking at something more top line?
Both. I think despite the optimism, which I think I share with everyone here, there are concerns the last 12 to 18 months have been a challenge for climate investing. Yep. In infrastructure, interest rates have affected the profitability of various projects. You add that up into a portfolio, and now you may have a climate infrastructure portfolio that is below its target return, and there's concerns there. Supply chain still is an issue for some things, and that was also a factor. And then so much capital came into climate venture capital and growth equity over the last few years that maybe there were some tourists in there overvaluing companies, and now asset owners, institutions are sitting on funds that may have overvalued portfolios, and there's concern there. And so, yes, the focus should be on the financial return, but also what is the climate objective in each business or project that is intertwined with the business model that generates either a unique climate output as well as the financial return.
So we should find a way to put other measurements into it in addition to the financial measurement?
Sure, and they should co-link together, right? So people using a new water technology like leak detection to reduce water savings, that's going to help that company be more profitable. At the same time, you can measure the gallons of water that's saved on a regular basis, just using water as an example. And you can use that in terms of renewable energy as well as other sectors.
Okay. How are you thinking about measuring this? What's success look like?
So success looks like for us is that, just as to the point of what Mark was saying, was when we implement these technologies, whether it's in our refinery, whether it's in our upstream business, but on a large national scale, how much, if more efficiently, are we reducing the usage of traditional resources of energy? How are we, becoming more efficient in our heat processes? How are we reducing our methane leaks and detection? And then obviously that's just not only on our company scale, but also on national scale as we implement these technologies and roll them out. And of course, that has also a financial reward for us. More profitability, reducing a lot of costs when it comes to the actual costs that go into the various different energies, and then conserving our natural resources for a longer period of time as we introduce newer technologies into our power mix.
So I think we're sort of an interesting moment. It's especially an interesting moment for me to be at Milken. I think I came here 5 years ago, something like that, right after Biden had been elected, or maybe somewhere in there. And now we're here for Trump too. Obviously, the way the White House talks about it has changed radically. America's not the only one playing out there. There are a lot of different people. On day 2 of the administration, the White House issued an executive order saying, what was it, no more grants for the IRA, for new IRA technologies to companies with, which had been run previously by the Biden administration with an idea of innovating. So I'm just wondering, talk to me about the political climate. We've also seen Morningstar noted a huge rush of funds out of ESG this quarter. It was just really negative numbers. So where are we now politically, Mark? And what's the environment like? What are you seeing and what do you think?
I can only reflect what clients and asset owners are thinking, and you hit on a few good examples. And again, I mentioned this concern about some of our climate-focused infrastructure investments. So some of those may have underwritten IRA tax benefits that are no longer there, and so that is affecting the performance. So there's just concern there. One big thing that I think a lot of folks were pretty excited about was climate justice, and so making renewable energy more affordable and accessible to lower-income communities in the United States. There's been that battle there of pulling that out because the administration did not like that. Folks who have a lot of wind assets are pretty concerned, and so maybe that is going to pump the brakes a little bit on those, unfortunately, even though that capital is so needed. One thing that we've done recently is we surveyed about 43 asset owners and allocators. And what I mean by allocators, that can be a bank, that can be a Cambridge Associates that manages numerous asset owners. And we asked them, all right, where did you invest over the last 12 to 18 months in terms of your broadly speaking impact, but also climate objectives? What are you looking for in the future? What could hold you back from your new investments? First off, most folks invested in climate over the last 12 to 18 months. I know it's very broad, but that was going to be a focus over the next 12 to 18 months again. None in venture, focus on infrastructure. So these asset owners, and this represents $1.7 trillion. I think that's pretty important. They want to focus on climate and infrastructure. What can hold them back are two things. One is political uncertainty. They may just kind of tighten their belt in general, even if it was not a climate-focused investment plan that they had, but particularly if they had a climate objective, people are going to, 70% of this $1.7 trillion said, we are concerned about the political environment, but also liquidity. So folks don't have the free cash flow as much, and they're not willing to lock up their capital in a long-term climate fund. They're going to keep it liquid because of the uncertainty. So from an asset owner's perspective, there is concern of the noise and the uncertainty.
Right. RH, I know you don't want to necessarily comment on the political situation in the United States, but I wonder whether the change in administration has changed your plans at all in terms of how you're investing, or whether you guys are just continuing to keep on keeping on.
So from our perspective, we continue to be focused on looking at, alternative sources of energy for the next 10 to 20 years in our plans. But we have seen a change within the venture space, how people are presenting the various opportunities, how they're actually approaching different types of national oil companies or IOCs with the various technologies. It's no longer that kind of climate bucket or sustainability bucket, but how it actually can help support the bottom line of these companies. And that's what we're seeing, a change in the approach of how things are being presented.
But are they also clean technologies? It's just a different approach?
Exactly, absolutely. So
well, isn't that better? Is that
exactly? I mean, what I'm trying to say is that it actually doesn't change the conversation. It just actually, presents it to the point of how it actually works for the IOCs and the NOCs, because it actually fits much better with our strategies. Because at the end of the day, we don't want to move away from utilizing oil and gas, but how do we make ourselves much more efficient and be able to, keep the resources for the future generation? So I think it is an opportunity to kind of clean out the impersonators in this space, but actually have the people who are really solving for the various pain points in the energy sector.
Huh, that's an interesting perspective. Scott, go on. I know you have something to say. He was telling me that they really haven't done anything yet. So go on. You go on.
Again, I think the headlines are very misleading at times. The headwinds are real. I mean, Neely talked about a sentiment cycle and a political cycle that I think are definitely more negative right now around a lot of the things that we all invest in. That doesn't mean the actual returns are negative. It doesn't mean the opportunities are negative. In fact, I think our customer demand is probably higher today than it's ever been. And what you're seeing is an imbalance of supply and demand. There's a huge demand for capital. There's a huge demand for solutions in the real economy. And a lot of the misinformation is preventing people from mobilizing capital. Liquidity also being a part of it. I'll point out
misinformation from the White House, from the press. Who's
anyone who doesn't actually have the expertise in the very specific areas we're talking about. So you have to be an energy person to understand the energy market in the U.S. You have to not only be an energy person to understand the energy market in the U.S., but if you're talking about battery storage, there's a lot of technical knowledge around the specific technology for battery. There's a lot of technical knowledge of the power markets in the specific power markets that you might consider putting a battery. There's a lot of technical knowledge on how to contract with various people in the supply chain and also with your customers in order to make a deal work. None of that gets covered in the Wall Street Journal. None of it, right?
Bloomberg's totally different. We cover all of that. Go on.
My point is that there are very few places to go to get a truthful, in-depth analysis of the facts, except for the practitioners. And the practitioners are keeping on, right? The practitioners are seeing customer demand as big as it's ever been, especially when you talk about electricity in the U.S. We've got load growth for the first time in decades, friends. Mm-hmm. Like this means we're building new infrastructure to meet people's needs. Not only that, we have multiple trillions of dollars a year needed just to replace the really terrible infrastructure that we have that's 50, 60, 80 years old in the U.S. that the Army Corps of Engineers grades at failing grades.
I just want to say I live in New Jersey and we still have knob and tube because we're near Edison's original factory. We have the original knob and tube stuff going through the ground. But I hear what you're saying, but I want to go back specifically to the IRA, and then I'm going to go to Neely. But I want to go back to what's happening with Washington. Talk to me about the impact of that law and now what's happening.
So I think the impact of that law was it brought a lot of attention to clean energy technologies that were a little bit earlier stage than some of the ones that we see out in the world in high volumes like solar and wind. Importantly, it was really an effort to catch up with China. Let's be really honest about this. This is industrial policy that China has had in place since 2005 with the 11th five-year plan, the 12th five-year plan, and all of the work that they've done to coordinate the various actors in the economy that you need in order to build new industries. And China is leading the way, whether it's electric vehicles or batteries or solar production or LEDs or rare earth minerals. They are crushing the whole world. competitively in all of these new industries. The IRA was an attempt to catch up, not to lead. Importantly, the IRA is not the only policy that happened in the last 4 years that has an impact on what we're talking about. The bipartisan infrastructure law actually matters a lot more to us as infrastructure investors than the IRA. Most of what we do at Generate is much more relevant to the infrastructure law than sort of new technologies that might attract funding that the venture capitalists are grateful the government might help them fund through the commercialization cycle. But again, a couple things I really hope we ground ourselves in with facts. First, infrastructure, which is 8 out of the 9 trillion. Remember, 8 out of the 9 trillion that we need is infrastructure, and infrastructure is determined at a community by community level from a policy standpoint. It's not federal policy typically that matters. So the infrastructure law is important, but far more important is what's happening at state and local levels for us in terms of building infrastructure projects. The second point is that the IRA has not been changed. Nothing has happened there's not been one piece of legislation relating to energy in Congress that has passed in the last several months. There is a lot of work being done, maybe behind the scenes, around the tax law. There's obviously a lot of impact of tariffs. And I would say that most of the impact of the current administration on our market is with respect to capital flows and the uncertainty that has been introduced into the economy in the last several months, specifically because of trade, right? And that trade-based uncertainty adds to what was already a difficult environment. Mark talked about it the last several years with inflation and interest rate volatility, not to mention geopolitical volatility. Those sorts of things create uncertainty for investors and make them much more nervous about putting capital to work. And we're talking about a capital-intensive thing to rebuild the world. So anytime capital is frustrated, capital flows don't happen normally and reasonably, that's a problem. That has nothing to do with energy policy. That has nothing to do with the IRA. Last thing I'll say is Trump 1.0. We heard a lot about revitalizing the coal industry. You know how many new coal plants were built between 2017 and 2021? 0. You know what those 4 years were? The best 4 years in the history of renewable energy. So let's just remember facts. Let's not just read headlines. Let's talk to practitioners. And most importantly, let's deal in the real economy. People who need problems solved.
Neely, what are you seeing now? I don't think you're as optimistic as Scott is, but maybe you are.
Well, I like these facts that you speak of. You know, I really agree that we should actually first start with talking about the real economy. We're finance people. We're going to talk about policy, but real economy, real companies, real communities is where the rubber meets the road. In my role, I get to talk with a lot of CEOs, chief sustainability officers, also CIOs, and you know, I've had hundreds of conversations since the election. I've never spoken with a company that said, you know what, we're going to let go of our net zero target. We're just not going to do net zero. However,
Boy, I feel like there's been a lot of retrenchment there, but go on.
For 2050 or 2060. However, there is a lot of conversation going on about the interim strategy, right? So not the long term, what are we going for in the long term, but in the intermediate term, how are we going to get there? And it's actually not just because of policy, it's also because now a lot of companies, countries, cities, states, philanthropies, they all have 2030 interim targets, and now it's in your 5-year planning window, right?
Right.
So it's getting serious. And it's not just policy that's changed. The market has changed. Technologies have evolved. Costs are coming down in many cases, right? And so there's a strategic discussion underway about how we do this, but I really haven't heard anyone say, you know what, we're not going to try to do this at all. So that's the first piece that I wanted to share. The second piece is people behind the scenes have been saying, listen, climate has been kind of a tip of the spear for, during the Biden years, right? Climate has been a leader, like at the kind of a top of the headlines. And that is changing, but because of the progress that we've made, climate thinking is embedded in other disciplines that are now at the top of the headlines. So, and when you think about how governments around the world are thinking about trade, a lot of their trade policy and industrial policy is rooted in their thinking about long-term industries that will win, which are green industries. So green industrial policy is just part of trade policy. You think about energy security, a lot of this will be on the back of green and renewable energy. You want to talk about supply chain security, same topic. And so climate is inside of the system because it had, in some ways, because we made progress while it was at the top of the headlines and the tip of the spear. That's the second thing. So there is a broad market dislocation right now. We've talked about the pressures on climate investing and the eco edge. Right? The whole market is volatile right now. There's pressure across the markets. I've been an investor for a long time, and markets go through cycles. What I think you will all agree is that actually sometimes the headiest periods are not the best periods to allocate capital. They're not the best periods to invest, that opportunities really emerge when there are openings or dislocations, right? Or that saying, the best time to buy is when everybody else wants to sell.
Sure. Buy the dip.
And so at Carbon Direct, we've been actually seeing a lot of opportunities coming forward, especially from the public markets right now, where there's more dislocation just because of their highly liquid nature. And so really thinking about what is out there in terms of take private opportunities, carve-outs, we even some companies where you'll see businesses where you're like, I love this business, but I don't like it as an investment because of the valuations, right? So in some ways, there are tailwinds coming forward in this period. So the last thing that I wanted to share is in thinking about this context, as you look again now at the business case for climate investment, kind of three quick frames for how to think about what that business case looks like right now. First of all, you do want to look where you can for solutions that are just cost saving or are at break even with the incumbents, right? And this does exist where green solutions in many cases are just cheaper or equal priced, and that's why they're selling and they're seeing revenue growth. The second area is where you just have very forceful secular trends driving demand, right? There's just a forceful demand trend looking for clean, renewable, clean energy at affordable prices. Energy security also has just a secular push behind it. And then the last thing is, you said it in your question, the U.S. isn't the only government. There are some trends where we're seeing a lot of global policy push and support, and that's really important too. So I'm really interested, and we're investing behind sustainable aviation fuel mandates coming forward, blending 5 to 10% by 2030, where the cost for not doing it is just more expensive than buying this sustainable aviation fuel.
This is great because I think in our last round, I'm going to ask all of you for some specific things because I'm sure some people in our audience. But I want to do a very quick lightning round. When you talk to people, or my people in Washington talk to people in the Trump administration, behind the backs they'll say they don't think America should be in the clean economy. China's already won. Like basically that economy, you use the words crushed. I think that's correct. I mean, everything from clean cars, batteries, solar, I mean, all of it's coming out of China. Is there a way for America, is it to win at the clean economy, or are we just putting, every investment dollar is also putting make us less competitive with China? And is there a way to do a lightning round on this? Who wants to start?
I mean, I'll just set the stage. There are over 150 different segments of what we would call the resource revolution, doing more with less of our resources. It's all an economically driven value proposition. 150 plus segments, right? I named 5 that China is winning in. I also would point to the fact that most companies are global. Unless you're actually counting on a complete decoupling of the world where there's the China sphere and then there's the non-China sphere, Ford is competing with all of those Chinese car companies, and they are losing. But that doesn't mean they're going to give up. They have to compete to win. They have to find a way to beat the competition the way that they had to try to find a way to beat German competition in the car industry, and Korean and Japanese. I mean, it's a global industry and it's a global market, and we here in America can buy all of those types of vehicles except for the Chinese vehicles for now. But the Chinese vehicles in many cases will win on price performance once they are allowed to compete here. And it is pushing folks like Jim Farley, who's very open about the fact that he at Ford is having to redesign their product portfolio to compete with a Chinese set of competitors. And that's true in any of these 150 different segments. Almost all of them are global supply chains, global industries. And any of the companies in the US that want to compete as manufacturers or as service companies or whatever, they're going to have to compete with a global market.
Anyone else have thoughts on China that they want to drop in and competing with China and while still staying competitive?
I agree with Scott. Said in a different way, I think that the U.S. still has the opportunity to lead in many different industries and sub-industries that are just still a bit more nascent, so a bit earlier stage. And I think that the advantage that we've demonstrated in other areas that are deeper tech can carry forward here as well. Okay. And at the same time, I think that the leadership that China has shown on things like solar and EVs is a benefit to the world that we shouldn't bash.
That's true.
Not bashing, it's just we don't have the same kind of
You
coordinated.
didn't bash it, but some people
Okay.
do.
Yeah.
No, I didn't. So here we have, we're going to do one more question where I'm going to talk about where people are most excited right now. Like if you're looking out in your portfolio and you see opportunities, where you're most excited. I'm telling the audience this, that in 5 minutes or so, we're going to start taking questions as we get towards the end of the hour. So I wanted to put that in the audience's mind. And then, Arish, let's start with you. What are you most excited about right now? Like if you had, what's the most exciting thing coming up in the future?
I mean, I think, just to the point about like competing with other countries, I think the U.S. has done a very good job when it comes to nuclear technology and the whole space of SMRs. And I think for us, we're part of the first program with the U.S., and we're very excited about the different technologies that are coming out there and how that can play a part in our future energy mix and how we can,
small modular reactors.
Exactly. Sorry, small modular reactors. And I think that's kind of very exciting for us when we're looking at the fission versus the fusion technologies and how that plays a part. And I think the U.S. Has done a very good job with the small modular reactors.
Okay. You want to go ahead?
I think I'm still optimistic about the $1.7 trillion that's going to double down on climate investing, particularly focused on infrastructure. I think that's pretty exciting, as well as this thing we keep hearing about, the great wealth transfer. And I've seen that number go from 49 trillion to 85, depending on what population and date you're talking about. But that population is going to invest very differently. It's going to be climate focused, and they also consume very differently. And they're going to demand products, resources, and services from very clean companies, talking about the real economy. One specific thing just kind of excited about was an investment Capricorn just made. Again, part of this ecosystem building beyond our OCIO business is investing in asset managers that we think have a leading edge. And we recently invested in a firm called Closed Loop Partners, which is a well-respected leading circular economy asset manager focused on food waste, water waste, recycling infrastructure, as well as innovative recycling technologies. And so super excited about how we can catapult that firm, because they do infrastructure investing, they do venture capital, as well as private credit. And the last thing too is I think there's more excitement to do credit in climate investing. There haven't been that many opportunities over the last few years. It's really been venture, it's really been infrastructure. And so we're starting to see groups have credit strategies that are very critical and capital flowing there. Because again, if you're an OCIO and you have a climate-focused institution that wants climate in every asset class, well, you better find something in credit as well. And so starting to finally seeing really good credit strategies is very promising.
Okay. We keep talking about infrastructure. You talk about infrastructure. Can you just be a little bit more specific about where opportunities are there?
So let's just think about energy transition. So solar, wind, storage assets. And again, of course, there's things in fusion that are still way out there in geothermal. But just thinking about electric vehicle infrastructure, that's been hit a little bit, but we're starting to see and invest in things focused on electric maritime transportation, as well as large trucking that is electric, and even kind of small, mid-sized trucking companies. Again, that's part of transportation. That is infrastructure. I can keep going in terms of...
Right, but all of that isn't held up right now? All of that isn't just held up with doubt, like we're not sure what the future looks like, or is that still moving ahead?
Still moving ahead. I don't have a doubt on that at all. Again, I think when I think of mega trends right now, AI and climate. I don't think climate is going away. Mega trends, and so we have to think about that with investor lens, is AI and climate is going to be in all things. But infrastructure can be very, very broad. And again, expert is Scott here, so he can provide better examples, but it cuts across numerous industries.
Okay, Neely, you want to?
I'm at the intersection of Mark's key trends, AI and climate. We're really focused right now on data center decarbonization. You probably can't go to a panel at Milken this year without talking about the explosive demand for AI compute power. When you think about decarbonizing the data centers to do it, you're going to need clean, low-carbon baseload power, so not just renewable energy. And actually, people talk less about the fact that the cement and steel and other physical products that go into building a data center can be like about 30% of the emissions in bringing it about. So we're really interested in longer-term solutions for clean energy. Yes, nuclear. Yes, advanced geothermal. But in the near term, it will probably be a lot of carbon capture with natural gas. Green cement, green steel, and things like this are very much in focus for us right now as investors.
So Scott, you mentioned that you have a big, broad portfolio. If you had to sort of look out and see where you see returns, the most exciting returns in the short term, maybe do a short term, midterm sort of look for us.
Yeah, I'd really be doubling down on what Mark said. We have a big private credit business. We've been investing in projects for 11 years, credit for 11 years, and companies for a little bit less. And in all three areas, we're seeing the best economic opportunity we've had in 11 years. In credit, for example, we've invested many billions of dollars over the last decade at high teens rates of return. That's a great infrastructure credit book. I don't care what we're competing with. I'll compete with anything with those kinds of risk-adjusted returns. In projects, we also get mid to high teens returns on owning projects that live in communities for 20 or 30 years and have contracted cash flows and proven solutions and actually deliver all of these co-benefits. But first and foremost, they deliver the investor the great risk-adjusted returns that
Give me one example, like the project that...
Well, so I'll give you a couple. We started, 5 years ago working with a school district in Florida. Most people wouldn't think of this as infrastructure. They came to us for a lighting retrofit. A lot of the lights in their school district were, fluorescent lights. And it was hard for the students to learn in that kind of an environment. Now, mind you, this is a 220,000 student school district. It's the 7th largest school district in the country. Their real estate is the size of Central Park in New York. It started as a $40 million retrofit of the lighting environment. And it's turned into a $650 million upgrade to their entire physical plant. and it has done everything from HVAC upgrades to lighting to roofing to insulation to energy management systems. We get a terrific risk-adjusted return. Obviously, we wouldn't do it. Otherwise, we have a 25-year contract with a single A-rated credit, which is a wonderful municipality in the state of Florida. It's a red county, by the way. And importantly, they're saving 30% on their energy bill. That money goes into classrooms, which means that it's funding teacher salaries that are going up, and it's funding school supplies for the kids, and the test scores went up. I mean, what's not to like about that situation? You don't have to be red, blue, green, or purple. Like, you just have to say, as a human, that's a win, right? Another example is the data center stories that we've heard about here. We build multi-solution microgrids so that data centers can get up and running today and not wait 5 years for a GE Vernova gas turbine or a 4-year wait in the interconnection queue for the utility. These data center users have demand right now. They need to get clean, firm power right now. And you can get clean, firm power doing it the way we do it in a behind-the-meter distributed set of solutions in 12 months instead of 48. And so that's a really important area that is driving enormous growth for us, but it also is an opportunity to shift the grid completely. We will see the data center demand growth shift the makeup of our grid over the next 7 years. And if you want to get excited about something from a climate standpoint, you can get excited about that. If you want to get excited about something from an investor standpoint, I've just given you pretty good examples of risk-adjusted returns that are hard to beat in other areas that are clean or dirty or what have you.
We should always leave it with you because it's always the happy note. We now are going to take some of the questions from the audience. I think the first question is for you. It's an anonymous question. What sorts of emerging clean technologies are at the right level of maturity to scale into the Middle East?
I think technologies that are already have raised their kind of Series A round, they already have some revenue generation, some kind of proof of concept with other clients. And technologies are probably the easiest that are great to kind of scale because then we can identify the use cases, we identify where they're able to fit in. Of course, I can't speak on behalf of other countries, but at least that's what we see here in Bahrain and what we see with the peers that we co-invest with across the region. At the end of the day, these are national assets, so we're not going to basically try ideas on paper, but things that can actually work and we can pilot them very well. I've been with BAPCO now for the last 10 months, and we've already piloted 3 different technologies that have already had their proof of concepts, have some clients, and are able to kind of integrate and build some business cases across.
Do you want to give one quick example?
Sure. I mean, there's a technology, and I'm not sure if I'm able to kind of say their name, but they basically focus on methane detection. They use cameras to be able to detect methane leaks. But at the same time, as we piloted them in Bahrain, we've been able to identify other use cases as they use AI as part of their whole kind of buildup, how we're able to kind of do tank monitoring, how to detect other types of gas leaks, and basically create efficiencies across a 90-year-old oil field and an asset in our upstream business. And so that's been very exciting for us to see. And then we're looking to see how that can be transferred across the border with a lot of our peers in the energy business.
Okay. Neely, I think maybe this one's for you. Can anyone comment on investment opportunities in negative carbon techs like direct air capture?
Investment opportunities in direct air capture?
In negative carbon tech like directed air capture.
Yes. I can comment on that.
Because carbon's in the name.
Yeah. So, when I think about negative emissions and carbon removal, there's a lot of focus that goes into direct air capture, and it's important to acknowledge that there's a broad range. Everything, obviously, from nature-based solutions up into DAC, which is in some forms the most expensive form of carbon removal. And then you also have hybrid carbon removal, which is like taking biomass, removing the CO2 and storing it, and you can use the biomass to produce clean energy or other things. We at Carbon Direct are very focused in trying to find that happy point between kind of price, which is more scalable, and obviously the scientific integrity and durability of the storage. Last year, when you look at the markets, most of the volume was actually in those hybrid solutions, in kind of things like biomass with carbon capture and storage, bikers, and others.
So we have time for one last question, and I'll read, and I'll throw this open to both Mark and Scott, but it's sort of an interesting question. It focuses, this says COP30 will be in the Brazilian Amazon this year. Does any of you already have exposure in nature-based solutions in that region? If not, any specific reason? And I was thinking of you guys both with your investment portfolios. Neither of those sound like nature-based solutions. Is that sort of a thing of the past, or is that something that you still see opportunities in?
Are we talking about nature-based solutions for carbon credits or other nature-based solutions, thinking sustainable agriculture, forestry?
Right, I think we're talking broadly here. The question didn't specify.
Okay, absolutely. So we've invested in strategies focused on sustainable agriculture and forestry. Forestry has been tough to deliver real assets returns over time. It has not delivered for the last 5 to 7 years, so it is a challenge. There's still all the benefits of, as an inflation hedge and low correlation, but it has been a challenge. I think the agriculture industry is still evolving. People talk about regenerative agriculture, not knowing what that fully means, and the carbon aspects of it are still early. So I think initial step, we're seeing more capital here in the US go into organic farmland investing, and so that is something that we have done as well. In terms of the kind of natural capital and carbon, yes, we have as well, and I still think that's a little bit of a challenge. The voluntary carbon markets from natural resources is still a little bit of a challenge.
Yeah, they've been shrinking. Why don't you bring us home? We have 3 more minutes. They're all yours.
Well, just to the question, we own a wonderful sustainable infrastructure business in Brazil that does sanitation and energy efficiency for municipalities largely that don't have either street lights or sanitation in their, their obviously growing economy. We don't have exposure to nature-based solutions. We are hearing more questions about it, and I think it's not a thing of the past. I believe it's absolutely a thing of the future as we continue to understand the environmental externalities of our resource systems. But I think that's a big part of what we all need to try to learn more about. And ideally, it would be wonderful if there were a systemic change to price those environmental externalities into the system. That would be the only silver bullet that I can imagine to actually help us resolve at scale some of the questions that we've been considering here. In the absence of that, and I'm not, by the way, optimistic, I'm quite sober about how hard it is for 185 countries to agree on anything, much less something like this. But I do think it's really important to remember again that asset by asset and customer by customer, people are choosing to take the cleaner option because it is the more economic option. And that is just far too infrequently discussed in the current media environment. The reason that I said, during 2017 to 2021, the coal industry was not revitalized, and what did see exponential growth was renewable energy, is because of the economic value proposition. It is cheaper to build a solar plant than to build a coal plant. It is cheaper to deliver renewable electricity to customers than it is to deliver fossil-based electricity to customers in almost every market in the United States, and certainly in almost every market around the world. It is the economic choice that will continue to drive this transition. It's not policymakers who drive the transition. It's not technologists, sorry, Silicon Valley, they don't drive the transition. And it's not even financiers, sorry friends, and Wall Street, we don't drive the transition. What drives the transition is people who have a problem to solve. And as far as I can remember, my time in business, it's been good business to solve a customer's problem. Let's just stay focused on that.
Terrific. I think that's a terrific place to end it. I want to thank you all for staying with us for this hour. And I want to thank our terrific panelists for your very good insights. Thank you all.
Thank
Thanks
you.
so much.